Hey gang, welcome back to Time in the Market, the 23rd best investing channel on YouTube according to my mother. Thanks, Mom. Way to believe in me. This is why I have self-esteem problems. We're going to have some fun today. We're going to talk about another Spac investor presentation. Again, I am not a qualified financial advisor. Do your own due diligence. Talk to someone who is a qualified financial advisor before investing in any of this stuff. This is all very speculative, as all SPACs are. And today, pretty much very, very speculative. I had another very there. We're talking about Ginkgo Bioworks going public via SPAC via the SRNG, Soaring Eagle Acquisition Corp ticker. The market doesn't care. It's $9.87, under $10. So you are currently sitting on $10 worth of cash for $9.97 with the opportunity to trade it for a company if you want to hold it past merger. Seems like an okay deal to me, unless the deal is absolutely terrible, which we'll see. I don't think it is. You know, there was some rumors around this deal coming out in the 20 billion range a couple of weeks ago. It ended up settling in the 17.5 billion market cap range, 15 billion EV range. So, you know, seems reasonable for at least a company like this. However, you know, what is Ginkgo Bioworks? It's a biology company. They are on the forefront of DNA synthesis, bacteria synthesis in the lab, that sort of thing. Kind of a big deal. You know, if I think about the future, in 2020, there will be robots. Well, there are some sort of robots. But if I think about the future, you know, I kind of look at some of these biology-based companies, you know, creating meat alternatives, lab-grown meats, lab-grown bacteria, lab-grown DNA, medicines that are, you know, DNA-based, like, you know, even the Myrna vaccines that recently came out. You know, it's a whole new step in technology that is going to drive improvements in a variety of industries, and Ginkgo is there from the beginning. Whether or not they're going to be a big success there, who knows? I mean, but at the end of the day, personally, I see these industries as the next trillion-dollar companies that are probably valued well below that right now. So if this thing can really take off, and it's going to take years and years and maybe decades for this to really be a huge part of our lives, but it's beginning already and it's being utilized already. And Ginkgo is certainly one of those companies. You know, they have, they're a relatively new company, started in 2009. One thing to note is that they had a financing round in 2019, September 2019. Raised 290 million bucks there. I think they were valued about 4.4 billion at that point. So clearly big step up in valuation from there, about 3x. But, you know, there's certainly been a lot of that going around, as the stock market has been absolutely crazy since 2019. So, you know, not unheard of for things to triple in valuation. A lot of stuff going on with these guys recently. There was a recent post I found that from Reuters that basically said, hey, the U.S. government is working with these guys, gave them a 1.1 billion loan to kind of work with them on global biosecurity infrastructure. Clearly, we just went through a little bit of a pandemic that was a bit of an unnerving situation, and certainly a horrible situation that we should have been more prepared for. So hopefully the government is taking some steps to be better at that in the future, and working with companies like Ginkgo is a way to do that. They've been working with Moderna for the pandemic response and kind of supporting them on process optimization. They weren't involved in creating the vaccine, as far as I know. I think that was all internal with Moderna and Pfizer. But if these guys can get involved in some other ways and potentially make some money on the side from that, that'd be great. And obviously improve the technology that's out there. They are working with Roche to develop some better and newer antibiotics. You know, they are a bacteria-grown company, so clearly that is useful there. And there's, you know, some deal notes here that, hey, if Ginkgo can bring antibiotic candidates into the clinic, they can stand to receive 160 million out of 300 million that Roche has committed in development and potential sales milestones. So clearly there's some deals that they make that are specifically driven by success, right? So if things don't pan out, they possibly don't make a lot of money, but if things do pan out, there's some sort of royalty or equity share Speaking of equity shares, they have a similar deal with Kronos Group to sort of develop cultured cannabinoids. Way to have culture there, guys. And if they can do that, they are going to get a specific number of common shares in tranches, subject to Ginkgo's achievement of certain product milestones. So we're talking equity share there as well. And then let's look at the company and really kind of figure out what it is. I am not a biology major or anything like that, so understanding some of this stuff is going to be beyond me and probably beyond a lot of investors who are more finance-based and not really in the thick of it when it comes to biology by design. But hey, they have a pretty cool website, so that's kind of neat. Scaling COVID-19 testing, what are they doing? They're scaling COVID-19 testing for communities with Concentric by Ginkgo. They're kind of laying out what they're doing, protecting the most valuable technology with IARPA, optimizing processes for vaccines with Moderna, discovering and testing antibodies with Berkeley Lights. So they're clearly working with a lot of companies, changing the future of food, designing probiotics for plants, enabling bioremediation solutions with Alonia, water remediation, agriculture, food. You can use a lot of this stuff for a lot of different things, and I think they're going to have a hand in a lot of different industries. And if they can get an equity share or a royalty share on some of the stuff they do, then potentially this could be a really solid business if a lot of this stuff takes off. So what are they doing? Future of Food, founded in 2018 and powered by Ginkgo's platform. I think Motive Foodworks is actually a Ginkgo spin-off company, so whatever that may be. If you hold this company for years and years, is it possible that you'll sort of get some spin-offs in the future? Sure. They're probably going to have their hands in a lot of different buckets, and if they want to spin off some of these buckets to unlock some value, hey, maybe that'll happen. Hey, they're discovering and developing new meat, dairy, and plant-based proteins made by fermentation, not animal agriculture. So again, a lot of this stuff, cattle industry, which includes both beef and dairy products, represents a 1 trillion global market opportunity and contributes to 9% of global greenhouse gases. What are they doing? We're working towards a future where genetic engineering can help make foods that are sustainable, healthier, delicious, and accessible to everyone. So a lot of companies are going to be doing this, but if these guys can have their hands in a lot of buckets and potentially work with some of those other companies, say, maybe we'll give you some of our technology that we've developed. Hey, we've developed this new bacteria. We've developed this new protein. If you want to use it, sell it in your $6.99 a six-pack burger. Maybe if you give us a cent for every sale, we'll let you use it. That's the kind of business I'm imagining here. So a lot of cool stuff here to really dive into, but we don't have 10 hours to talk about this stuff, and if you want to learn more, you can probably visit their website or talk to biologists. But for us, we're going to look at their investor presentation. Let's grow with Ginkgo. We've got a little plant growing. How nice. At least it's not a weed. I just bought a house, and it's all covered with weeds right now. Transaction overview, right into the thick of things. So that's good to see. We've got our calculator open. We've got an Excel spreadsheet open. So they have entered a definitive agreement to merge with Soaring Eagle Acquisition Corp, valuing Ginkgo and an enterprise value of $15 billion. Again, much better than the $20 billion that was rumored a couple of weeks ago. Maybe some of that was like, hey guys, these SPACs are kind of blowing up right now. Let's go back to the negotiating table and make a deal that's a bit more reasonable. All primary transactions will result in gross proceeds of $2.5 billion through a combination of $1.725 million cash in trust, so $1.7 billion cash in trust, $775 million of committed PIPE financing, including commitments from Bale Gifford, Putnam Investments, Counterpoint Global, and a $75 million investment by the Soaring Eagle sponsor group. So they're investing a bit more money because they believe in the company. 30% of the sponsor share promote converted to earnout. Additionally, Ginkgo shareholders will be granted up to 180 million shares, so 11% additional shares vesting between $12.50 and $20 a share. So there's some good news there in terms of that, hey, Ginkgo shareholders are getting some additional earnout shares, but they're going to be vesting at a certain price point. So, there's incentive for the company's price to go up, as there should be. You shouldn't just be granted free shares. There should be some sort of management incentive to grow the stock price. And some of the sponsor promotes are also converted to earnout. So there's going to be some sort of target there as well. Closing expected in Q3, so not too long from now. So what are they doing here? We got $1.7 billion in cash, $775 million in proceeds from PIPE, You're talking about 15 billion in equity holders rollover. Nobody's selling anything, so that's good to see. Most of that money, besides the transaction fees, are going to the balance sheet, so that's good to see. Well-structured deal here. Let's look at the shares here. Assumes no redemption, inclusive of value, blah, blah, blah. Represents estimated transaction on a 755 million pipe. Enterprise value calculation excludes 18 million in financing lease liabilities as of 12/31. So there's a slight, difference maybe between that and some lease liabilities. Includes, so 5 is the number of shares, which is important. It includes 1.5 billion consideration shares to Ginkgo. So those are just the regular shares. 172.5 shares to SRNG shareholders, so me and anybody else who's watching this video who owns SRNG. Disclosure, I own some SRNG if I haven't said that before. 77.5 shares to PIPE shareholders and 30.2 million shares retained by SRNG sponsor, inclusive of 150,000 shares transferred to SRNG's independent directors. Does it include that, the 11%? Did they say anything about that? So this includes 274 million cash balance sheet as of 4/30/21, excludes restricted cash and any disbursements that may be made from the US loan that we saw, and assumes no redemption and excludes SRNG, Ginkgo earnout shares, and SRNG warrants. So this excludes this. So there's going to be some dilution, right? Excludes earnout shares and SRNG warrants. So it's okay. So let's look at dilution. There's 780. What was it? 0.3? Was that right? Yeah. We've got 172.5 million SRNG shares. Is that correct? That is correct. The good thing about this one is that the units were a 1/5 warrant, so there's not going to be a ton of dilution there. So you're talking about an additional 34.5 in dilution from warrants, and then these Ginkgo earnout shares. Assumes no redemption and excludes SRNG. So are these sponsor shares not included in here? I wonder. It's hard to tell, but it wouldn't be a big deal because it's only 2%. So that's going to be relatively immaterial for how small it is. But let's say there's 180 million earnout shares that are not included in there. So you're talking about potentially 10% in dilution, which isn't terrible compared to some of these other SPACs, where you see 20% plus due to warrants, due to additional earnout shares, whatever. So not too bad. Not obviously dilution's never good, but at least the dilution here, for the most part, the majority of the dilution comes from these earnout shares. If you're just talking about warrant dilution, you're barely in the 2% mark, right? You're 2% off. So 2% dilution that has an 11.50 strike price, basically another 8 to 9% dilution between $12.50 and $20 a share. So not terrible. I mean, deal structured pretty solidly. I like to see it structured this way. If dilution does come, it comes at a certain price point, mostly above $12.50. The dilution from warrants is minimal because the units were structured that way. It wasn't a 1-to-2 or a 1-to-1 or a 1-to-3 unit structure. It's a 1-to-5. You've got a ton of cash flowing into the balance sheet, 2.3 billion here in addition to the 274 that they have on the balance sheet already. So you're talking about a 15.1 enterprise value. 15.1 billion. What's the market cap? Just to have it down here, 17.8. And then we've got, this minus this in cash, 2.7 billion in cash. Pretty good. 2.6, whatever. It's close enough. Structure-wise, company owns most of the company. The current owners own most of the company. Shareholders own about 10%, relatively standard. PIPE shareholders in there at a small valuation as well, and a 2% sponsor share. So cool. Good structure. Our mission: make biology easier to engineer. Blah blah blah. Started, these guys in 1972. They certainly got a lot younger in 2006. So they're onto something here. They've discovered the cure for aging backwards. Good for them. Good for them. Is this the guy right there? That's that guy. And this guy's right here. Very cool. Very cool. Good for them. Let's invest in this company. They've really outdone themselves by aging backwards. So we can program cells, DNA, like we program computers. Yeah, it's the future. I like it. Cell programming is increasingly impacting our lives. Ginkgo's work on close material gaps in the mRNA vaccine supply was recently featured on 60 Minutes. Vaccines are developed and manufactured using cell programming tools. Certainly happening. There's a lot more stuff happening. What are they talking about? Antibody therapeutic development, antibiotic, gene and cell therapies, microbiome therapeutics. I do think there's a lot to be said about bacteria and utilizing bacteria for everything. There's a lot of bacteria that's so helpful to human life, and most of it we probably don't know at this point. So there's so much ahead in this industry, and being able to invest, even if the valuation sucks right now, which it probably does here, I'm sure they're making no money, being able to invest in something like this, while it's certainly not going to be a put all your money into it, for me, it's probably going to be, I think this could be $1 trillion company in a decade. If the things that they need to happen go their way, if an uptick in utilization from this goes their way, if they start getting royalties from some of these programs that they're involved in, if they're successful, if they start getting equity from some of these companies that they're involved with, if they're successful. So a lot of challenges ahead for a company like this, but potentially a lot of rewards. Even though the starting point's relatively high, right? $15 billion is not a small starting point. But this is in my mind the future of a lot of industries. And if Ginkgo is going to be there helping these companies get there, if a lot of these companies don't do it in-house, then hey, this could be something special. But again, if they are not on the forefront, if a lot of these companies do it in-house, then hey, this could be a complete disaster, right? That's the beauty of stock investing. Industrials and environment, food and agriculture, I think that's a big deal there. Consumer and technology, probably a slightly smaller deal at this point, but eventually, hair care, skincare, etc. It's going to be a huge deal. But for me, it's pharma and biotech and food and agriculture that are, at least right now being a big play on this forefront, and here too, I guess, wastewater, renewable chemicals, etc. Can you design bacteria that are going to, you can just drop them on an oil spill and they eat it all up immediately? Can you design bacteria that gets rid of chemicals faster than we currently get rid of them, etc. There's just so much that you could do with stuff like this. Pest control, making animal protein replacements that are better for you, healthier for you, less dependent on random weird ingredients that are more alike to the actual thing, that don't require you to have additives in terms of vitamins and minerals and stuff like that naturally exists in meat, reducing sugar in products, reducing fertilizer, making plants more efficient and more durable, etc. A lot of stuff here. There's a lot of stuff. What companies are they working with? We sort of looked at some of these. Roche, Moderna. I'm not familiar with a lot of these companies. Cargill, ADM. These are agricultural companies there. And then there's a technology layer, there's a program layer, there's a platform layer. Can they integrate their own hardware, software, etc. into other companies' stuff? Can they work with these other companies that are looking for somebody to manage their programs to kind of work with them? And can they have an internal platform that other companies can kind of work with that ties all of this stuff together? And I think that's really where they're going and where they're going to have to go to be a successful company. So we program cells for our customers so they can develop new products. They've got a Ginkgo Foundry where there's an input, the customer gives them specs, they design a bunch of stuff, and then they output a cell program. They've got a big code base. It's clearly continually improving as they get more information, as they design new things, as they learn new things. It's all inclusive automation, hardware, software. They've got the tools, the code, the organisms, etc., and they spit something out that other customers can use. Customers can also run their own programs on Ginkgo's platform to drive business value. So they partner with Motive to develop more delicious and sustainable food. But again, Motive is their own company, so they're not really partnering with anybody at their own company, guys. Come on. In just 1 year, 6 prototype strains were developed and product samples were produced for benchmarking and early application testing. Improved variants were designed, built, and validated over the next 9 months. The strain's performance exceeded Motive's specifications by 70%. 303 proteins sourced, 300% improvement over unmodified strains. Kind of takes about a year to do it. So this stuff is going to be a long-term thing. There's continually going to be improvements on whatever it is Ginkgo is doing. As this becomes more and more common, more and more competitors are going to enter the fray. So stuff's going to get tough. This is, again, you're investing. To me, this seems like a venture capital investment, which is why I kind of like SPACs, to be honest, because they allow you to get in on something that you would never otherwise get into, right? And that's kind of good for investors in a way. It can be bad for investors because one of the reasons a lot of these SPACs are going public via SPAC versus getting money via Series E, Series F funding, which is venture capital stuff, is because they can probably get, hey, we can give you $3 billion at a $15 billion valuation, whereas, in 2019, they were getting $200 million at a $5 billion valuation, right? And maybe that would have changed by 2021 on the venture capital side, but potentially it's not as good as it is on the SPAC side. So you're seeing a lot of these companies going public probably before they're really ready to go public. We've talked about some of these other companies in previous videos where it's like, well, I guess this technology is cool, but most of it's not ready until 2025. So why the hell are you going public now? Take some money on the private side and kind of stay on the lowdown, develop your product and go public later. But also, I understand the allure of the owner saying, hey, I can get $1 billion right now, and you can give me a $5 billion valuation right now for something I haven't even made. Hell yeah, I'll take it, and then I can sell some of my shares and be rich. And maybe this will work out, but maybe it won't. It's a lot easier to do, a slight exit from the side of the owners when they're getting such a big chunk of change from SPACs. So SPACs can be good, SPACs can be bad. Got to be wary of the risks that come with it. I think the reason a lot of these SPACs are down right now is because people are starting to realize that, hey, maybe some of the deals that were made a couple of months ago just weren't really good deals, right? And I probably shouldn't be a long-term holder of something that's going to dilute in a couple of months and is not going to make any revenue until 2025. So you got to take your bets. You got to place your bets. I think a lot of these SPAC plays are very speculative. You're sort of saying, I believe in this technology. I have the ability to get into it now, and I'll give it a shot, right? Because if you think about if Ginkgo is very successful, and they didn't go public today at 15 billion, maybe they'd go public in 2027 at 300 billion or something like that, right? And at that point, maybe you'd be like, yeah, I want to invest in this company, but you can invest in it now, right? And on the opposite end, maybe they're not successful at all, and you're paying 15 billion for a company that's down to 3 billion 2 years from now. Who knows? Who knows? That's the beauty of SPACs. You don't know. So you've got a pretty decent founding team. You got a DNA hacker, Tom Knight. What a title. Been together for 20 years. A lot of young people here, so good for them. Good for them. And then you got Soaring Eagle, which is a solid company. I will say so myself. And then you've got an independent board that's, on a couple of companies, whatever. So what do they believe? Programming cells will be as impactful as programming computers. You really do have to believe that to make that investment. Ginkgo's platform improves with scale, and they're certainly going to get scale with more money. Ginkgo is becoming the industry standard. That is good to hear. And our value increases with each new program added to the platform, which again makes sense, right? It's probably not going to be a huge revenue boost, because I think the way these guys function is we can do something for you guys. It's probably not a lot of revenue up front, but if it's a success, we want a little bit of it, right? That's the kind of deals we're making. We want something out of that. And being involved in royalty streams on a successful product is very good, and being involved in equity share on a successful product is very good. So programming cells will be as impactful as computers. Again, what are you doing? Redesigning life. what the planet's shutting down, and then a year later, hey, we've got this freaking amazing vaccine that is going to change the world. Maybe, who knows? Some people don't like it. I have been vaccinated, but whatever. R&D spending alone is a ton in terms of what companies are doing for cell engineering lab operations. This is obviously not just Ginkgo alone because it's in the billions, but you've got tools that are being made, labor that's being produced, and this market, presents over 20,000 plus potential new cell programs if, Ginkgo is involved in a few of them. And you've got a massive emerging market for bioengineered products. You've got health, food, and agriculture. Really, these are the two that I sort of mentioned earlier, food and agriculture and health. And some of these other ones will certainly emerge in the future, but they're probably not as huge a deal right now as they will be once this has been shuffled, because these are the important ones, right? I'd rather have the cure for some bad disease than a cream that makes my skin look better. So focus on this. I'd rather have food and agriculture that's cheaper and less impactful to the planet to make and healthier to eat than a shampoo that makes my hair nice and silky. Although being silky smooth is very important as well. So a lot of good stuff there. But these are really the areas of focus. But you're talking about 2030, 2040 here, and that's probably accurate. This is going to be a long-term discussion. So, the fact that this stock isn't reacting, I've seen some people say, well, if this was an IPO, this thing would be up to 200%. Maybe, right? But are they really that much of a guarantee right now? People are a bit wary about the stock market right now. If inflation rears its ugly head, if yields start going up, a lot of these SPACs are going to get killed, and a lot of these growth stocks are going to get killed, as they already have in the last couple of days and weeks, because people are going to search for safety. Some of these valuations have run away on the idea that yields are going to stay low forever, and if that changes, then hey, we're going back down to reasonable valuations. And, what's reasonable, what's not reasonable? I mean, 30x, 50x, 100x sales probably isn't reasonable. And really, that's kind of what I'm expecting here, that it's going to be just an absolutely unreasonable valuation. Ginkgo's platform improves with scale. Well, yeah, that's usually how it works. Over 70 major customer programs across diverse industries have run on our platform. So what are they looking at? Consumer and technology, industrial and environment, agriculture, food and nutrition, pharma and biotech, government and defense. Couple of their specific programs. So they've got early experimentation making flavors and fragrances. Then they're moving into industrial chemicals. You've got your Bayer for agriculture joint venture after some industry vetting. You've got Motif launching portfolio of animal-free protein programs, mammalian capabilities, and Synlogic partnerships. And then you've got a diversified platform that can respond to emerging opportunities and global threats. So, if the U.S. government is giving them money, is that a good sign? Certainly, but again, the U.S. government gave Kodak some money to change their plants to create vaccines or something, or whatever crazy thing that was. So the government doesn't necessarily spend their money on guaranteed things. So what are they using their platform on? You've got commodities, specialty chemicals, textiles, environment, high-tech electronics, repellent cannabinoids, fragrances, fertilizer, crops, animal feed, animal-free proteins, flavors and sweeteners, nutrition, brewing and baking, microbiome, therapeutics, biologics and gene therapy, antibiotics and APIs, COVID vaccines and therapeutics. A lot of stuff's happening here, guys. These guys are all over the place. The thing with a company like this is there's going to be a lot of corporations that say, hey, I have this great idea. Can we make it work? And Ginkgo's probably going to say, yeah, we can give it a try. And I would assume that 95% of this stuff is just going to be a complete bust. Right? But maybe it's the 5% of the stuff that's going to be like, wow, we really hit something here, and this is going to change the world. And if Ginkgo is involved in that, and they get a royalty payment from that, or they get an equity share in that company from that, even if it's small, hey, these guys are making some money. And then, as success comes along, it breeds more interest and it breeds more success. So that's really all that has to happen. And clearly Ginkgo's already had some success because they're working with a lot of different corporations, and they've kind of gotten this this clout thing that, hey, if you want some weird organism stuff, you probably go to Ginkgo. Although there's probably other companies as well, because they have this, state of the art facility. They have other stuff going. Knight's Law, our scale theory. The cost to genetically engineer a cell decreases by 50%, and the number of designs tested increases by 3 times per year in Ginkgo's automated cell programming foundries. So one thing that worries me about stuff like this is that that's true. Like, it's the same thing with computers. Computers get better and better and better every single year. And, imagine if you started a company that was based in computing in 2010, and then you look at 2020, the difference is night and day, right? And the difference in cost and quality between 2010 and 2020 is night and day as well. So you're looking at this company that's set up now that potentially has the best setup in the industry by 2020. They've spent all of this money on these, on these things, on these machines that they're working with, on these programs that they're working with. By 2025, those things will probably be Stone Age, right? So how much are they going to have to replace? How easy, as long as a company gets some money, some funding, and has, a similar background, if one of these guys leaves and starts their own company, they get a $2 billion influx of cash. Now they can just do the same thing, and they can have a thing set up pretty quickly with brand new equipment that's much better, while Ginkgo is kind of changing things around. I don't think that's a huge issue, because again, Ginkgo has the database that they can use to build upon, and the infrastructure that's already built upon, and they can, again, they still have to spend that money to upgrade their stuff if they're a new company. So, but that's something to keep in mind. The stuff that they're using today is probably going to be much, much better by 2025. So there's going to be a lot of expenses coming forward. It's not like, hey, we have this facility already set up, we're all set, we don't have to spend a lot of money. There's still going to be capex, like, whoa, every single year with this stuff, as this stuff improves. The cost decreases, but it probably comes with increased costs in upgrading their tech, software, hardware, whatever. And while that's true, it's going to take a while to get to a point where this stuff is super, super cheap. So there's still probably a ways from there. And then they're scaling 3x per year. Lab operations, measuring work done on the platform, was growing pretty quickly pre the pandemic. And then you've got strain tests measuring the output on the platform, again, growing pretty quickly. And then drops in the pandemic, but still happening. Things are still going on. And then unit costs have decreased by 50% per year. So you can kind of see getting much, much cheaper. And this is really why companies are starting to take off now. Companies like Ginkgo are starting to take off now. You can say, well, this company's been around since 2009. Why haven't they done much with this technology until 2020 potentially? Well, because it costs like thousands of dollars to do anything with this thing before 2015, and then it sort of started getting a bit more attractive as these costs got better and better, as the technology got better and better, as their expertise with it got better and better. So they're cheaper than what everybody else is doing, because they know what they're doing, and the cost now is 10x less than it used to be. So that's kind of a big deal in only 5 years. And then clearly there's some stop here for whatever reason, but you're going to get a drop going forward as well. And then they've got their code base, right? Their data sets that they have, 3.4 billion unique gene sequences, 440 million proprietary gene sequences acquired. People aren't going to have that, right? If you're the number one player in biological code, that's as if owning the programming language for computers, and you're the only one that can do anything on computers. That's kind of a big deal. So we'll see where that goes. And then they have a lot of access to other stuff. They're learning from wild biology to grow in their database. So I think they're certainly working quite a bit on improving that and expanding that. And it's going to take another company years to get there if they're competing. So that's certainly a business advantage that they have. Some stuff again on their plant-based meat industry, working with Motif Foodworks, again, one of their own companies. Is this thing going to be spun off in the future? Probably. I mean, why not spin off some of these businesses that they have built in-house? Improve it, code base improves efficiency and outcomes. The same yeast used to generate proteins for food can produce proteins used in personal care products, such as collagen, elastin, and keratin. Very cool. And they've got a virtuous cycle which drives platform growth. So this is like all over the place. So you add a new program, it lowers your cost structure, it leads to lower cost per program. It's a value proposition. There's a value share that comes out of that. You can, if their value proposition is there, there's the demand for more programs. It improves your code base because you're working with companies that are in, different industries and may have different DNA structures or proteins to work on. You've got an improved program technical success, and then it never goes back to the adding new program. So you just sort of you add a new program once, and this isn't really a cycle. It should tie back somehow. I guess it ties back over here, maybe, I don't know. And then we believe they are becoming the industry standard. Is this true, right? So each new cell program can accelerate adoption within new markets and lead to further sales with existing consumers. So you've got existing customer accounts, sorry. You've got a proof of concepts that starts. You add a major program, a couple more proof of concepts. You add another major program, a couple more proof of concepts, a minor program here and there. And then you've got a few more major programs and more minor programs that are kind of talking about one specific customer probably, that, hey, we started with something that was small and then we've suddenly got a bunch of major programs. There's a footnote here. They typically incur well over $500,000 of annual R&D spending. Minor programs are typically smaller add-on programs that have less than $500K of annual R&D spending, and proof of concept programs are typically small programs that are often set up as a business development effort. But really, the idea here is that, hey, we can work with new customers, and if this proof of concept things works out, we're suddenly in this area where they're allowing us to spend $500,000 on R&D spending multiple times, multiple programs, kind of to develop things that improve their business, right? Because at the end of the day, $500,000 in annual R&D spend, when you're talking about companies that have billions and billions and billions in revenue, it's not a huge deal for them. The question is, is it easier for them to work through Ginkgo? Can they do a lot of that stuff in-house? Certain corporations certainly can do some of that stuff in-house. Maybe that will happen eventually as they learn more about the process, but right now it seems like a lot of them are coming to Ginkgo. And then you've got early proof points with an industry that can lead to follow-on demand. So you've got confidential stuff with Moderna that they're discussing with other companies now. Again, stuff like that does matter. Seeing hey, Ginkgo picked up this government contract for biosecurity. Ginkgo works with Kronos to develop something. Hey, maybe some other companies in that industry will be like, well, maybe we should be doing something in that space as well. Maybe we should at least talk to them and see what they got going on. Obviously, we can't do the same thing that Kronos is doing, but maybe they're doing something else. Maybe we could do something else. Same thing with Moderna. The Moderna thing was big, right? You can kind of get some news out there that, hey, this company exists. They're involved in kind of improving the process for the Myrna vaccine. When there's other vaccines, is it going to be a yearly thing? Hey, let's work with Ginkgo every year. It's simple. They're doing their job. They make our life easier and they make us more money at the end of the day. And now if Moderna's doing it, maybe Pfizer's going to do it. Maybe Johnson & Johnson's going to do it. Maybe other companies are going to do it. So there's certainly a lot of stuff going on, but not all of it's going to lead to deals, but more and more deals means the potential for more and more deals, like that little circle was that, hey, if we can get more customers, we can maybe get a better cost structure because the machines are potentially running all the time instead of only sometimes, and we can have all of our people employed and working on different programs. And some of these programs may be kind of similar to programs we've already done before. If we can lower that cost, we're going to be a better proposition for customers. At the end of the day, if they want to do it internally, maybe it costs 5 times more than if they want to go to Ginkgo, because Ginkgo has such a database already set up and they've done similar things already. And then, hey, if they go to Ginkgo, maybe they give them some sort of value share, or they just give them a bunch of money up front, whatever they want to do. And they've got a strong 2021 sales pipeline with a mix of new customers and expanded relationships and multi-product collaborations with top global flavors and fragrances customer, expanding successful historical program execution, new relationships with top 5 ag chem company, and you've got launching a new spin out in personal care space with strategic and financial investors. That's interesting. So I wonder if these spin outs how will they work? Will they still be under the umbrella for now? I don't think these companies are publicly traded. I don't believe Motif is publicly traded at this point. But hopefully, if they're launching some sort of spin out, the current shareholders of Ginkgo will benefit, which I think they would. So you've got your historical programs and then what they're adding in 2021. So some skin microbiome stuff, some recycling stuff in the pulp and paper wastewater remediation area. Not a lot of crop protection, but maybe one new thing I added there. A bunch of pharma and biotech, and then a few in the food and nutrition space and the government and defense space. So you're going from 73 major programs with a potential for 23 in 2021. So pretty decent growth. I'm sure they're going to kind of speak to that later in some of the financials. And then their ecosystem is going to support hundreds of new cell programs a year. So they're talking about, hey, we're adding 23 in 2021, which is about there. Then suddenly in 2022, it's 60, then 136, then 268, then 508. And then it's still only 1 to 2% of the market that you have for these R&D services. So clearly there's a lot of opportunity here. Whether this platform can scale that well, whether they can expand so well within their base, whether they can have a better support or self-service portals by then. You're seeing very small growth between 17 and 23. Clearly you can say, hey, there's a pandemic. A lot of people aren't spending money. And then this growth kind of is exponential, basically 100% a year or so. Pretty big. We'll see if that actually happens. But hey, certainly optimism here in what they're doing. And they're creating the industry standard. They have a ferment, Ginkgo Ferment, an annual conference where people probably talk about whatever scores they get. Yeah. Ecosystem. Great. What is this? There's capital flowing in, capital access plus foundry credits, mature manufacturing network across industries with clean tech transfer protocols, open source bioengineering tools, Ginkgo annual conference, source of innovative technologies, biosecurity, ESG, etc. I love GMO. Grow. Okay. And then our value increases with each platform added to the portal. Makes sense. Each program added to the platform. Programs drive both predictable near-term revenues, okay, finally we're talking about revenues, and long-term value creation via asymmetric upside potential. So you've got the foundry, which is where they do their R&D, right? So you've got your upfront payments to cover R&D costs for customer programs. It's highly predictable revenue that's independent of program success. Then you've got downstream value, which is value sharing via customer equity and or royalties on completed programs. I think this is where these guys are going to make or break their business model, right? At the end of the day, this is going to be some money, but it's probably not going to be a boatload of money. At the end of the day, they can't charge a ton, or a lot of these companies will take it in-house if they are able to. But if you can show that there's success from these programs that they are doing the work on, then they can have some sort of royalty stream or an equity stream based on the success of the corporation and the success of the program, rather, right? So you've got cash flows from a value share are typically 100% contribution margin, as Ginkgo incurs minimal ongoing support or delivery costs, which makes sense. Once it's kind of R&D'd and here's your thing, the company probably produces their thing, and one of their SG&A costs is, hey, we have a 0.01% royalty to Ginkgo for using their technology that they developed for us. And you've got a choice to downstream economics where you can structure it as royalties, which is kind of more consistent, or equity, probably dependent on customer size. The smaller the company, I'm assuming they'd probably structure it more in the equity space. If they're kind of diluting their stuff anyway, might as well dilute it some more. The larger the company, there might just be a royalty stream. They don't typically give you a piece of your equity pie. They're not issuing shares, they're buying back shares at that point. So interesting structure here. But again, this is where this company is going to be making their bread and butter. It's all going to be dependent on how successful are these programs that they're developing, because at the end of the day, if they're not successful, sure, they may get some money here and there's probably not a lot of margin on this product. The idea is that, hey, if we're successful, we're going to maybe even lose money on this, but make up the money and this equity share or royalty stream that we're getting. You're talking about unit economics are strong and improving. So Ginkgo has steadily increased the portion of program R&D costs that are covered upfront by customers. So in 14 and 15, the coverage was about 15, 17%, something like that. By 2020, 80% of the R&D costs are covered upfront by customers, and there were some free COVID services that they did. So essentially, most of their costs are covered upfront by customers, right? Whereas before they might have said, hey, we'll just, you can give us the money when it's done or where it's a success or whatever. So clearly making this seems like it's being valued more by customers simply because they're covering all of the costs or most of the costs upfront versus covering none of the costs upfront back in the day. Then there's downstream value. Currently, they have 54 programs. 20 of those programs are structured on royalty and other, and then 34 of them are structured based on equity. Includes one program for publicly traded Kronos, which is structured as a lump sum equity payment upon delivery. So you're talking about them recognizing royalty revenues over time as programs are completed and commercialized. These should be roughly equivalent in value over the long run, but royalties take longer to materialize. The current equity value of our major programs is over $500 million. Clearly hard to tell how they're valuing that. I'm assuming it's possibly, Kronos is publicly traded, but they probably have 33 other companies that are not. So maybe they're just basing it off of current market caps on the secondary market and potentially current market caps for Kronos. So $500 million in current equity value. Whether or not any of that pans out is a question mark. Could be a lot lower if a lot of these companies go out of business. Could be a lot higher if some of these companies are a huge success. And as far as royalties go, again, it's dependent on the success of these programs and whether or not they're a success after they're completed and commercialized. So interesting to see here. I think this is really the big question mark in terms of valuation. They have all of these major programs. There's not going to be a lot of visibility, at least initially. Maybe they'll start reporting more info once they actually start reporting earnings, as far as what the projections are, what the current equity values are. Most of these things are sort of a toss up. You're like, maybe we'll get something. They got 20 programs that are currently in play, major programs. They don't say whether or not any of them are currently a success. They don't say whether or not any of them are currently in use at this point. Same with the equity stuff. Is the current equity value that has been realized over $500 million, or is it still dependent on those major programs being a success and being delivered? So a few question marks here, but hey, this is certainly a part of the business model that's going to generate a lot of value for investors down the line. So growth in foundry revenues and new programs drives valuation. So these guys are literally rocking $64 million in $64 million in foundry revenues. After some GAAP adjustments, they're rocking $59 million in GAAP foundry revenue. Then they've got these new programs that have about $15 million in risk-adjusted net present value per program, with $500 million of total net present value for all of those signed. They're thinking of adding a lot of new programs, and all of these programs will be kind of structured the same way. So when you look at a lot of this stuff, the question marks here are, who the hell knows what the actual valuation is for a lot of these programs? Are they successes? Are they not successes? These are based on management estimates of average current equity value of our cumulative major programs for 2017, 2020. You kind of have to trust management at this point. Whether or not these are going to pan out is a question. Clearly, they have a lot of optimism around new programs they're going to add to the platform. But you kind of have to remember this sort of stream that they're going to get, right? They are, even if they add a new program in 2021, it's probably going to be done by 2024. They're going to have some billable revenue from the foundry for that program, but the royalty payments or the equity share probably won't start until 2024, and it'll start to ramp up by there. So same thing for 2022, you'll get equity and royalty by 2025, and it might not ramp up to max until like 2030. So the majority of these programs aren't being added until the mid 2020 range. So really their revenue, if these programs are successful, is always going to be 3 to 4 years behind the programs that they're adding in terms of equity that they're getting, unless they speed up the time it takes from start to finish. So 2025 revenue success, even if these programs are added, who knows, the revenue realization there might not be until 2030. So you're really looking at a at a potential 2030 play with a lot of these programs being fairly valued in terms of, have they been successful? Have we gotten royalties from these programs? Have we gotten equity from these programs? And they're kind of, showing you that, hey, the valuation here right now, we might be valuing this at 500 million. The future valuation of all of these programs, it's certainly going to go up if the successes of these programs are there, and it's going to go down if the take rates are lower or if the successes aren't there. So it's all dependent on how well are they doing with their programs, how well are they monetizing those in terms of the royalties that they're going to get and or the equity that they're going to get, and how well are the companies that they have equity in doing, a couple of years from now, and how well are the products that they have royalties on today are doing a couple of years from now. Really, that's going to drive all that stuff. And while this is going to be potentially relatively predictable, right, your billable revenue for the foundry, potentially predictable if these programs pan out. All of this other stuff is a big question mark. So that's kind of a worrisome thing from an investor perspective, right? So at the end of the day, in 2024, you've got 628 million in foundry revenue, and then you've got 500 plus new programs that are out there in 2025. The value today is based on whatever their value add is, and in 2025 they're kind of saying that, hey, by 2025, this value add might be 7 billion when it comes to equity and royalty payments from all of the stuff that we've got in play, and then all the new programs that we're adding. If that's true, then hey, that's pretty good, right? Because you've got a current discount valuation of 25 billion right now just based on this downstream value, but that's all, it's all kind of up in the air, right? That's the risk you're taking with this speculative type of investment. And then you've got this other, hey, we've got a biosecurity thing that we're working with the government on. Could be a long-term revenue stream if the government's investing more in pandemic preparedness, et cetera, which they probably should, given that it completely destroyed the economy for a while and the lives of many, many, many people, which is, not something we want to happen again. And then you've got other stuff, licensing or manufacturing, VCE enzymes, whatever those are, and other types of revenues that are out there. So again, this is a very difficult business to kind of understand because it's so dependent on everything that they're doing. And all of the stuff that they're doing is very much under the covers, right? You can't know who they're working with that well. You can't know exactly what they're working on. You can't know what kind of deals they have in place with all of these companies. They're sort of like, we have an equity deal. Even the deal with Kronos is kind of like, we'll get some equity, But it's like, how much equity are you getting? What's happening? What are the goals? What are the yields? What's going on for these royalties? What are the royalties? Are they good? Are they bad? So yeah, you can say that they're valuing them at 7.6 billion, but hey, where's that coming from? Right? You just sort of have to trust management. But that's the case with everything. So it's not like it's an outrageous thing. They're sort of showing, hey, we're comparing this to 2024 revenue multiples for a lot of these other companies and a lot of these other growth tech multiples. We're at 17.5x. We're valued at 11 billion. We're valued at 25 billion here. So you're talking about, hey, by 2024, we should be a $36 billion company, which is fine based on all of these multiples and all of these assumptions. So you're getting quite a deal here at 15 billion based on our 2024 revenues. But so many question marks. Yeah, and yeah, Snowflake. You're comparing yourself to Snowflake, which is 100x revenue companies. So sure, they're growing pretty quickly, but right now they're 100x. And if you kind of look at Snowflake, people will also say, well, Snowflake doubled in their IPO. They started at 120, they doubled to 240, they ran up to the 400, and they're sort of kind of coming back to earth, right? This is the reality of some of these high growth investments, that if growth doesn't pan out even a little bit, and if there's some stumbling blocks, and if there's a correction due to rising yields or worries about rising yields, these things will tank. And the people who got in at 120 at IPO price, if they were able to get in there, probably did okay. But everybody else who got in post-IPO, all of retail, basically is screwed at this point if they're still holding, because they're at the lowest they've been since they've started trading. And how is SRNG doing? Whoops, SRNG, sorry. It's up 2 cents. We are rich. So interesting business model, right? This is one of these pharma type-ish business models where the investment you're making is not necessarily in what the company does, but in what the company can help others do and how they can benefit from what they're helping others do, right? And that's in the form of equity, that's in the form of royalties. So that's years away at this point. I don't think they're getting any royalties at this point, or they would have mentioned it, but we'll see if there's any more financial stuff. Valuation wise, I don't know if this is all of their revenue, right? You're paying $16 billion, $15 billion for $59 million in 2020 revenue. Yeah. Yeah. Nothing to say there. Leveraging capital to build the heart of the emerging cell programming ecosystem. So we are accelerating growth in capacity by integrating new technologies across the existing footprint, building new foundry space, and investing in software and automation to increase utilization. We strive to be the best place for the world's top scientists, engineers, and software developers to build their career. So if you look at this number, it's really ramping up. They are getting $2.5 billion in cash on their balance sheet. They can do a lot with that. Right, it's going to be a combination of improving their existing footprint, improving their space, and improving their automation and software. Right, that so they can be more efficient and take on additional projects that they potentially couldn't right now. Capital availability centers Ginkgo at the heart of the next generation of programs by providing access to foundry credits and capital. And then there's going to be strategic acquisition and partnership. And then Ginkgo has successfully acquired several technology and co-space assets. We plan to continue to selectively acquire assets in strategically important areas. And then the most powerful technologies require the most care. Our culture is built on care, transparency, diversity, employee ownership, and a deep, humble respect for biology. We invest in our communities and their biosecurity as well as robust ESG practices. Biosecurity is an important thing, and I'm hoping that the government takes a bigger look at that, which is another thesis for investing in a company like this. The government's already working with them on biosecurity. If this loan and this partnership can prove to be fruitful in the eyes of the government, then hey, government revenue is nice, and having it be a constant would certainly be a boost to the valuation of a stock like this. So we hope that when technology meets biology, life finds a way. Designed by Ginkgo, born in Boston. So they're kind of looking at, hey, what's our valuation like? We're growing at 84% between 21, 24, maybe certainly a lot better than a lot of these other players in this industry. If you're talking about your valuation in terms of just revenue, 24 1x, a bit rich, but then you've got these value shares that they're adding. Again, you're talking about potential net present value of something that may or may not occur. Here they're talking about 1/10 of cumulative NPV from new programs, so potentially a lot more than that if things pan out, potentially maybe even less, but it seems relatively conservative in terms of that. But even without that value share, these bioengineering, biochemistry companies are certainly valued very highly simply because a lot of people think that this is the next frontier of pharmaceuticals, of food, of everything, right? Genomics, etc. And Ginkgo is going to be right there, right? And if that is the case, these valuations are certainly reasonable based on expectations, right? But those expectations don't always have to pan out, right? You're talking about very, very good revenue growth. You were talking about uptick in usage of that technology, and maybe it's just too early for that, right? That's the risk. It takes a while for things to be widely used and widely accepted. And if 2021 is the start of that, then hey, this could be a really, really good investment. If it doesn't really take off until 2030, then we just may be too early. It doesn't mean that, Ginkgo won't be an attractive company by then, but it may take some growing pains to get there. But in terms of valuation, adjusted for growth and revenue, et cetera, it's sort of in line, even though the revenue is low. If you sort of look at some of these companies, even, some of these other growth companies that aren't necessarily in the pharma biotech space, they're still valued at ridiculous multiples, right? Today's multiples, I think Snowflake might still be close to 100x 2020 revenue. And maybe it's closer to 60x X 2021 revenue, but it's still quite ridiculous. So what are we looking at here? Biosecurity was a bit of a boost there. So it's not really 59, it's $77 million in revenue. So that's the thing, right? You have to be realistic when it comes to this company. You are currently getting a $15 company, a $15 billion company that has made $77 million in revenue in 2020. That sort of multiple is, how do I even put 0 points like that? Is that, 200x? Is that right? That's probably right? 100x would be 7.7 billion. Yeah. So 200x, you're paying 200x 2020 revenue. Nuts. Yeah, totally nuts. Probably in terms of 2020 revenue, might be one of the most highly valued companies right now, right? Obviously, there's companies that don't have any revenue that are valued at 5 billion from the Spac world. So at least they're making something. But again, it is certainly richly valued, but you're not buying the company today, right? You're buying the promise of all of these projects they have in place paying off, right? And in this 77, 200x valuation, you're ignoring that potential of $500 million in equity / royalty share that they are valuing at today's prices, right? And if that goes up, that's good. If it goes down, it's bad. But, it's there potentially. The success of this investment will all come down to, how well can they monetize the projects that they're working on. And if they can monetize those very well, then this could be a really, really strong investment in a few years, right? I'm not surprised that this isn't like taking off because it's so far away. This is another one of those SPACs that is still very much a 2024, 2025 play, because that, if they have these 2017, 2020 projects, what were there, 54 projects or something like that, most of the financials for those projects probably won't start to impact this company until 2023, 2024. And they're not even projecting anything right here. They're just projecting, hey, we think we can reach this with our foundry, with just our, R&D stuff that we're working with customers on. We're not showing any projections in terms of what's the royalty payments going to look like. Probably because right now they have none, right? They have 0 royalty payments. And that makes me think that maybe right now they don't have any successful projects that are generating revenue, right? They don't have any successful projects that are giving them true equity at this point, right? They're valuing them at 500 million, but is that on the hope that certain things will pan out in a year or two, or are certain things already in play? I don't know. They haven't really clarified that for me, right? As an investor, does that worry me? Yeah. Does it worry me that I'm essentially paying 200x for a company? Yeah. But I'm not buying the company today, right? I'm buying the promise of a new industry emerging off of what Ginkgo is doing and companies like Ginkgo are doing. And the way this is structured, right? It's structured on that basis, right? We're not investors because we want to make revenue out of the foundry, right? They're not going to make a ton of money from the foundry. They're going to make some, right? By 2025, all of the efficiencies and stuff might be that the foundry is profitable. And if that's the case, then fantastic, because by then they should be rolling in at least some equity and at least some royalties from the projects that they've worked on. And that's really what you're betting on, right? You're betting on the emerging businesses that they're building right now, the royalty streams that are going to come in a few years' time. And yeah, it's speculative. Yeah, you're paying 200x, but sometimes if you want to get in on the ground floor on something like this, that's what you have to do, right? That's why people were investing in this company in 2019 when they probably had less than 77 million in revenue at a valuation that was probably close to 100x at 5 billion, right? and now you're paying 200x at 15 billion. I mean, that's the price you have to pay for something to go public for you to get access to it, and that's fine, right? The return here won't be seen in a month. It won't be seen in 3 months. I think this is the type of company you sort of have to sit down on and say, I'm betting on the industry to be huge by 2030. And if that's true, then this will probably play out in a very favorable way. This is the first company that I've looked at where I kind of look at it and I say, could this be a $1 trillion company in the future? Inflation notwithstanding, any company could be a $1 trillion company if there's inflation. And the answer to me is, yeah, maybe, right? Maybe. The industry is young enough and interesting enough that this is going to be a potentially huge success, right? But you're starting at a $15 billion valuation, right? So the expectations are already pretty big. If the thing doesn't pan out, then it's a pretty big loss, right? But if it does pan out, then that's pretty cool, because this is a pretty cool investment. That's really all it comes down to, right? And it's silly to say that, but you sometimes have to make investments on the potential of something. And I think this company has potential, and that's why I'm going to hold the stock probably for a while. And maybe if it stays below $10 for a while, I'll pick up a few more shares. And that's hard to say when you look at this ridiculous valuation, but you're not looking at this from the perspective of a value investor, right? This isn't a value play. This is a pure 100% speculative, and the keyword is speculative, growth play in having faith in a developing industry and a company that could potentially be a big player in a developing industry, right? Because you see all of these things where our total addressable market is 10 trillion and we're going to do this and that and this and that. And most of the time I kind of look at that and I think, this is so dumb. Why would I think that, a freaking basically a helicopter industry is going to be a multi-trillion-dollar industry? Looking at you, all of those eVTOL companies, but with something like this, I'm like, yeah, maybe, and that maybe is enough for me to say, yeah, why not? I'll throw a couple grand at this. I'll hold this through thick and thin and see what happens in 2030. And I also have some eVTOL companies too, so it's not like I'm ignoring that thing, but really, this is again fully speculative play. If you're investing your life savings on this, you're probably, you're potentially dumb. I don't want to call you anything, but hey, it is what it is. You have to be aware that this is a very, very speculative play in an industry that's very interesting. And if you're aware of that, then hey, that's fine. And I'm aware of that, right? I think that the foundry will probably grow, maybe not as quickly as this, but the real meat of the investment is the secondary influx of income they can have from equity and or royalties. Because you got to remember, once the R&D is done, if they have a royalty agreement on something that's successful, that's basically pure margin. If they have equity on something that's successful, that's basically pure margin. So if they can really achieve positive EBITDA on their foundry business, and they have this rolling royalty thing that's, potentially, going to be up and down depending on how successful the product is, but again, is going to be potentially backfilled with new programs, then this is a really, really good business model. But this is not a really good business model today. It's a really good business model potentially in 2025, 2026, 2027, 2028, right? And I can picture that. And if you can picture that, then this could be an investment for you. So that's why I'm going to hold it, right? You can look at it and say 200x, ridiculous. But yeah, ridiculous today. But in my mind's eye, I can envision this being not ridiculous in 2025, more so then I can envision a lot of other industries that are going public via SPAC that have no revenue until 2025 and no actual product until 2025, right? So, yeah, expensive based on today's valuation, but interesting nonetheless. And I'll be a holder. I'm going to hold. I may buy more. I don't know. I already have a decent amount, so maybe not, but I may buy more. I am interested in this company. I am interested in this industry. I am aware that there's a shitload of risk that comes with investing at a 200x, $15 billion valuation company. But, that's kind of the case with a lot of these SPACs, and it's the risk you take for a potentially high reward. So that's it for the overall review. Looks like they have some case studies here. A leading company for production of natural ingredients was looking for cost-saving opportunities. Ginkgo identified a plan to fine-tune existing pathways in yeast to produce multiple flavors more efficiently, then optimize the conditions for scale-up. Utilizes reactor run using the Ginkgo exceeded the client's desired product titer by 50%, but it doesn't say if they got any money for that besides elapsed fermentation time. Ginkgo system enables high throughput screening without compromising quality of data. The volume conditions optimized at a volume of 250 milliliters were effectively translated into pilot and commercial scale, and the cultured ingredients reached commercial production with our manufacturing partners, Fermic Mexico. The Ginkgo Foundry allows us to synthesize, screen, and test for these proteins at a scale unmatched by others. In our primary screen, we screened over 1,000 unique proteins, testing a total of over 10,000 samples. From that screen, we identified the best hits. In our secondary screen, we discovered a protein that binds hard-to-recycle compounds 5 times more than previously seen in the market. Enzymes, culture. I mean, you can look at a lot of this stuff yourself. I don't want to make this video too long. But, you're looking at the beginnings of technology that is going to change the world in my mind. I actually think ARC is invested in this. A lot of people kind of look at ARC as SRNG pipe. Let's see if there's any pipe. I don't want to look at strong pipe. SRNG. Yeah, you've got ARC Investments, you've got Bain Capital, you've got Viking. I think Bill Gates is involved in this company, right? So if you kind of look at all of these things, a lot of smart money is interested in this, or at least, smart money on paper. So there's certainly a reason for it. And I certainly consider myself a smart investor. And I'm certainly interested. So, $122 million deal with Kronos. Plants like blah, blah, blah. Partnership. We are working to produce 8 targeted cultured at high quality and purity. To scale manufacturing, our development team supported the evaluation and build out of an 84,000 square foot fermentation facility in Winnipeg, Canada. Ginkgo sourced, synthesized, and screened, blah, blah, blah. Interesting stuff here. A lot of case studies you can go through. There's a lot. I won't go into detail here. If you're a biologist, let me know down below what you think about the company. If it's too early, if it's right on time. Clearly, a lot of these projects will probably fail, but some will not. And that's what you're betting on as an investor. Guys, let me know what you guys thought about the video. Leave a like, leave a comment, subscribe. Thank you for all the subscribers. I will do more of these videos. I will do more investing videos in general. Let me know what you guys want to see, but I hope you enjoy these videos. Hope you find them entertaining, fun, educational, whatever. As always, I am not a qualified financial advisor. Please talk to a qualified financial advisor before you make any investment decisions. It is important. You can lose money, especially with SPACs. They are quite risky. Thank you for watching. Have a good rest of your day. Enjoy your life, and I appreciate the views and comments and subscriptions and likes. Thank you.